to Bajaj Finserv Limited Q2FY24 Analyst Conference Call hosted by JM Financial. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sameer Bhise from JM Financial. Thank you, and over to you, sir.
Thank you, Zico. Good morning, everyone, and welcome to the Q2FY24 earnings conference call of Bajaj Finserv Limited. First of all, I would like to thank the management of Bajaj Finserv for giving us this opportunity to host the call. As usual, we will have opening remarks from the management team, and post which we will open the floor from Q&A. From the management team today, we have Mr. S. Srinivasan, CFO, Bajaj Finserv Limited, Mr. Tapan Singhal, CEO, Bajaj Allianz General Insurance Company, Mr. Ramandeep Singh Sahani, CFO, Bajaj Allianz General Insurance Company, Mr. Bharat Kalsi, CFO of Bajaj Allianz Life Insurance Company, and CEOs of Bajaj Finserv Direct, Mr. Ashish Panchal, and CEO of Bajaj Finserv Health, Mr. Devang Modi. With that, I would now like to hand over the floor to Mr. Srinivasan for his opening remarks. Thank you, sir.
Good morning, everybody. I welcome all of you to the conference call to discuss the results of Bajaj Finserv Limited for Q2 FY24, which also is the half-year ended 30th September 2023. I must apologize for the slight delay on the technology front, and I apologize for that on behalf of the company. As before, in this call, we will largely be concentrating on the consolidated results as well as the results of our insurance operations through Bajaj Allianz General Insurance Company, Bajaj, and Bajaj Allianz Life Insurance, BALIC, and where material, the standalone results of our company, Bajaj Finserv, BFS. Bajaj Finance Limited, BFL, which is another major subsidiary of ours, has already had its conference call on 17th October 2023. However, if there are any high-level questions on BFL, we will be glad to take that as well. We will not be taking any questions on the status of Allianz's stake in our insurance companies. The status has remained the same as at the end of the previous quarter, and there is no further update on that. Any statements that may look like forward-looking statements are just estimates and do not constitute an assurance or indication of any future performance result. Now, remarks on Ind AS. As required by regulation, BFS prepares its financials in compliance with Indian Accounting Standards or Ind AS. Insurance companies are not yet covered under Ind AS. They have prepared Ind AS financials only for the purpose of consolidation. Accordingly, for Bajaj and BALIC, standalone numbers reported are based on non-Ind AS accounting standards, Indian GAAP, as applicable to insurance companies. Our results, the press release accompanying the results and our investor deck have been uploaded on our website on Friday. And I do hope all of you have had a chance to go through the same. I will now move on to the business update. I will start with our mutual fund business, Bajaj Finserv Asset Management. Our AMC commenced business in this quarter, launching liquid flexi-cap and arbitrage funds. We are providing an update on this business in our investor presentation and will continue updating you every quarter. The total assets under management stood at 5,235 crores at 30th September 2023, with a market position of 29 out of 42. Over the next few months, BFS AMC will be launching other categories of funds, including balance funds, ETFs, etc. The start has been good. However, as you may be aware, the asset accumulation in the mutual fund business happens over the long term with SIPs and other formats of investment used by retail customers. We hope to be able to continue the initial momentum going forward. Now for the update on the performance for Q2 FY24. Macroeconomic conditions were favorable during the quarter with a higher level of business confidence. In this conducive environment, our companies have once again delivered a very strong operating performance. Let me start with Bajaj. In the previous quarter, we had explained how some of the initiatives we have invested in late FY22 and FY23, such as focusing on smaller tier towns with a multi-channel model, expansion of distribution, doing more with bank assurance partners, and increasing presence in the large ticket corporate segment was starting to bear fruit in terms of growth. I'm glad to report that this quarter too, Bajaj continued the momentum. Bajaj had an excellent quarter on both the growth and profitability fronts. Headline gross domestic premium income GDPI increased 53.6% YOY as we reported already, while core GWP excluding tender-driven crop and government health business grew 22.4%, both well in excess of the industry growth of 16.1%. Bajaj also has reported a 95.3% combined ratio measured as defined by the IRDA, along with an underwriting profit of 37 crore, which is its best performance over the last several quarters. With the aid of higher investment yields supported by strong growth in AUM, Bajaj recorded 39% growth in profit after tax. In Q2, Bajaj continued its growth in motor business, recording strong growth of 20% in the two-wheeler segment and 17% in private cars. Bajaj continues to be selective on the commercial vehicle segment, where it focuses on the lower risk and profitability, and hence this segment grew at a muted rate of 6%. Commercial lines, which include property, engineering, liability across MSME, SME, and large corporate segments, grew 8.6% as against an industry growth of 6%. A note on the earned premium. When growth is strong in the general insurance business, the earned premium grows less than the gross premium, as premiums are deferred across the tenure of the policies while costs are written off upfront. As a result, you may note that the net earned premium grew only 8% in this quarter, but this unearned premium is expected to get mostly earned in the subsequent quarters of this year and the first half of next year. Although I must caution here that if growth in GWP continues strongly, the additional premium will also take longer to get earned. For Q2FY24, the loss ratio was 78% as against 75.5% in Q2FY23. The combined ratio for Q2FY24, as I mentioned earlier, was a healthy 95.3% as compared to 99.8% in Q2FY23, driven by better expense ratios and reinsurance term. This is the lowest combined ratio in the last 14 quarters. We expect this will be one of the best among composite general insurers of companies of comparable size. During the quarter, Bajaj reported an underwriting profit of 37 crore as against a loss of rupees 18 crore in Q2 of FY 2023. In a market which is intensely price competitive, this operating result, we believe, displays Bajaj's commitment to a balanced and profitable growth on the back of strong sourcing, claims management, and effective customer service as indicated by low grievance ratios, high NPS, and low claim repudiation ratios. This balance, we believe, is very important for sustaining profitability in the general insurance business. Profit after tax of Bajaj at rupees 468 crore in Q2 FY24 was higher by 39% as compared to 336 crore in Q2 of FY23. The higher profit after tax was attributable to better underwriting results and better investment performance, including higher profit on sale of investments. Bajaj AUM grew by 13% to 29,511 crores as on 30th September 2023 versus 26,052 crore as on 30th September 22. The advance premium from long-term policies was rupees 1,643 crore as of 30th September 23, which is higher by 33% over September 22. In summary, an excellent quarter for Bajaj. I must however reiterate that insurance is a long-term business and subject to volatility in claims. We do believe that focusing on core principles of balancing growth with profitability and quality should keep Bajaj in good stead in the coming quarters as well. I will move to Bajaj next. In the previous quarter, Bajaj had reported muted growth in NBV, although growth in individual rated business was strong. We had mentioned in our call that we had chosen the relatively slack Q1 for launching a new ULIP product which is low margin and which caused the NBV growth to be muted. We had further indicated that we are taking steps to balance the product mix. I am pleased to report that with the launch of the 8th participating product, Bajaj has been able to correct the product mix and return to a healthy NBV growth. During the quarter, Bajaj continued its above-market growth trajectory and reported an individual rated new business growth of 32% against the industry and private players growth of 13% and 16% respectively. The market share in IRNB terms increased from 7.3% in Q2 FY23 to 8.2% in Q2 FY24 among the private players, leading to Bajaj maintaining its ranking on IRNB basis at 6th position and 5th position based on retail regular NB policies. Bajaj's 2 years IRNB CAGR of 32% in Q2 FY24 is among the highest in the industry. The total number of policies for Bajaj grew 23% to 3.16 lakhs in H1 FY24, which is the 3rd position among private players. and with the growth in Q2 being even higher at 27%. Overall, IR&B mix for Q2 FY24 stood at par 32%, non-par savings 24%, term 4%, annuity 5%, and ULIP 34%. As compared to Q1, par mix has improved by 19% and ULIP mix has dropped by 8%. In absolute terms, we have seen a significant growth this quarter in the term segment at 82% as compared to Q2 FY23 and 9% as compared to Q1 of FY24. During the quarter, growth was broad-based and driven by all the main channels, with agency, institutional business, and BALIC Direct growing at 34%, 31%, and 35% respectively. During this year, BALIC started activating several of the recently signed corporate agency tie-ups with AU Small Finance Bank, South Indian Bank, Development Bank of Singapore, City Union Bank, Tamil Nadu Mercantile Bank, Punjab and Sindh Bank, and Jammu and Kashmir Bank. Moreover, with the opening of a rep office in Dubai, BALIC looks to further strengthen their institutional business. BALIC now has a reasonably large number of bank assurance tie-ups, which should help it reduce concentration risk on its institutional business over the next few years. Another point I would like to highlight here is the various initiatives undertaken by BALIC to improve persistency across most cohorts, especially in the latter buckets. As of 30th September 2023, the 13-month persistency stood at 83%. The 49th and 61st month persistency have improved to 63% and 50% respectively. The increase in persistency over the last few years helped deliver a strong growth of 31% in renewal premium in Q2 of FY24. New business value, net of all expense overruns, grew by 25% from 190 crore in Q2 FY23 to 237 crore in Q2 FY24. Mainly due to a change in product mix and interest rate movement. Profit after tax grew by 21% from 160 crore in Q2 FY23 to 193 crore in Q2 FY24, supported by higher shareholder income, lower death claims, and partially offset by higher new business strain on account of business growth. Overall, a good balanced quarter for BALIC with a strong focus on retail distribution growth. We also saw BALIC bouncing back in profitability from Q1. Finally, both the insurance companies are financially among the most solvent, BALIC with 466% solvency and BAGIC with 352%, and hence are well poised to weather any external adversity. Let me move on lending business, BFL and BHFL. Q2 FY24 was another excellent quarter for BFL, with the company delivering on all its long-term financial guidance metrics, AUM and profit growth, return on assets, return on equity, as well as gross and net NPA. Continuing its growth story, BFL acquired 35.8 lakh new customers in Q2 FY24. The total customer franchise as on 30th September 23 stood at 7.66 crore, while the cross-sell franchise stood at 4.67 crore. Building on this customer franchise, the number of new loans booked in Q2 FY24 increased by 26% from 67.6 lakh in Q2 FY23 to 85.3 lakh in Q2 FY24. The company's diversified business model has enabled it to record a strong AUM growth as seen from the total AUM at 2,90,000 odd crores as on 30th September, which is 33% higher compared to the 2,18,000 odd crore on 30th September 2022. The quality of the book continues to be very strong, with the gross NPA and net NPA being 0.91% and 0.31% respectively, as against 1.17% and 0.44% at the end of Q2 of last year. BFL holds a management and macroeconomic overlay of 740 crore as of 30th September 23. The company has released 100 crore from the overlay in Q2. BFL ended the quarter with a consolidated profit after tax of 3,551 crore, which was 28% more than the Q2 FY23 PAT of 2,781 crore. The capital adequacy ratio, including Tier 2 capital as of 30th September 23, remains strong at 23.19%. The Tier 1 capital stood at 21.88. Bajaj Housing Finance Limited, the 100% mortgage subsidiary of BFL, continues to do well. AUM grew by 29% to 81,215 crore as of 30th September 23 from 62,931 crore on 30th September 22. Profit after tax grew 47% to 451 crore in Q2 FY24 against 306 crore in Q2 FY23. The capital adequacy ratio stood at 22.64%. The GNPA and NNPA stood at 0.24% and 0.09% at 30th September 23. In summary, another very strong quarter for both BFL and BHFL. Now I'll give you some update on our platform companies, Bajaj Markets, Bajaj Finserv Direct, which is also called Bajaj Markets, and Bajaj Finserv Health. During Q2 FY24, Bajaj Markets attracted around 1 crore consumers on its digital platform, of which 2.3 lakh became customers, as against 87 lakh and 2.2 lakh customers in Q1 FY24. The lending, unsecured and secured lending of both BFL and partnership business disbursement for the quarter stood at 1,658 crore as against 1,427 crore in Q1 of FY24. It also sourced 82,818 cards as against 74,146 credit cards in Q1 FY24. In all these metrics, Finserv Markets has shown quarter-on-quarter growth. In terms of Bajaj Finserv Health, they carried out 12.37 lakh health transactions versus 7.02 lakhs in Q2 FY23, having 3.4 lakh plus monthly active users. For the quarter, Bajaj Finserv Health had 15.74 lakh paying users versus 8.09 lakhs in Q2 FY23. With 4.3 lakh users having renewable products versus 2.27 lakhs in Q2 FY23. Bajaj Finserv Health is also expanding its provider network, which currently includes 103,000 odd doctors, 5,500 odd lab touch points, 2,000 odd hospitals. Using the network strength, Bajaj Finserv Health is able to offer and service differentiated product plans for both retail as well as to corporates for employee health benefits segment. In summary, both our emerging businesses have done very well in Q2 of FY24. I will now come to the highlights of our consolidated financial results, which reflect all of these and which has been put up in our press release on 27th October. Consolidated total income at 26,023 crore was up 25% over 20,803 crore in the same quarter of previous year. The consolidated profit after tax was up 24% at 1,929 crore versus 1,557 crore. Under Ind AS, the insurance subsidiaries have chosen to hold a large part of the equity securities portfolio at fair value through profit and loss account, which results in unrealized mark-to-market gains on losses on investments getting included in the consolidated profit. The amount was a loss of 72 crore in Q2 FY24 versus a loss of 21 crore in Q2 FY23. If one were to exclude the volatile impact of MTM losses and gains, the core profit after tax would have increased by 27% in Q2 of FY24. Before concluding, let me just highlight the half-year numbers as well. BFS recorded top-line growth of 34% in H1 FY24 at 49,303 crore. The consolidated profit after tax is a 35% increase at 3,872 crore. BFL recorded consolidated total income at 25,882 crore, which is a 34% increase, and a consolidated profit after tax at 6,988 crore, is a 30% increase. The ROE for the 6 months not annualized was 12.2% versus 11.7%. Bajaj recorded a 41% increase in premium at 11,132 crore, 18% increase in profit after tax at 883 crore, and an ROE of 8.9% versus 8.6% not annualized for the 6 months ended 30th September 23. The combined ratio for the 6 months was 97.6% versus 102% in the same half year of last year. Bajaj reported a gross written premium increase of 10%, an IRNB premium growth in excess of 30%, profit after tax increase of 23%, and an NBV increase of 2%, 331 versus 325. Before we open for questions, considering the paucity of time, I would request the audience to keep their questions brief and not repeat questions which have already been answered so that we can cover more queries during the call. With this, I invite questions from the audience. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question is from the line of Swarnabh Mukherjee from B&K Securities. Please go ahead.
Hi, sir. Thank you for the opportunity and congrats on a good set of numbers. So, I had a few questions on Bajaj. So, firstly on Bajaj, regarding the tender on the government health side, I just wanted to understand, in your presentation you have highlighted that there is an impact that has come in worsening of the loss ratio for the health segment. So if you could call out whether this 8.5 odd percentage point impact is only due to government health or the loss ratios maybe of the three health segments separately, that would be very useful. And also in terms of the inward reinsurance commissions, what would be the quantification as a percentage of NWP, that would also be very helpful. In terms of the profits, I think the profits were supported very significantly by the investment income. So wanted to know whether that would be sustainable or not. How should we think about it? For BALIC, I just wanted to understand the VNB margins on a 12-month rolling basis. We are still below what it was last year. So understand that first half have been largely driven by ULIP and PAR. So how should we think about the second half? Do we plan to push non-par products? What is the appetite you are seeing on that side? So comments on VNB margin on that, and also factoring in the EOM guidelines, what would be your strategy for that? And one bookkeeping question on BALIC is, if you could call out the share of Axis Bank in our IRNB and the counter share there. And lastly, one quick question on Bajaj Health. So in the presentation, I see an increase in terms of insurance partners on both life and general insurance side. So if you could highlight who you have tied up with and what is the kind of scale you expect out of these partnerships.
Yes, sir. Thank you. I think it is Bajaj Finserv markets, I think you're talking about in terms of increase in number of partners and health as well. Okay. You have asked a few questions. The first one was on the health loss ratios and the government health scheme on Bajaj. The second was on the investment income and whether it was sustainable. And the third was on the reinsurance commissions and how much it was as a percentage of NWP. In terms of life, you wanted to know why the 12-month rolling margin is still lower than the same period of last year. And you want to know what is the concentration of business on Axis. And on Bajaj Finserv Health, you wanted to know the onboarding of additional partners on the insurance side. So I will first start with Raman to take the three questions on the general insurance side, followed by Bharat and then Devang.
So I'll take the first question on the health portfolio. To answer your question, whether the loss ratios have worsened in all the segments, answer is no. Actually, if you break the segments in 4 parts, one is retail health. There the loss ratios have indeed improved versus last year. We had seen a lot of increase in severity in the last few quarters. That is kind of getting negated now, because we had mentioned, if you recall, in the call 2 quarters back, that we were seeing a lot of frauds happening. And some of that is getting addressed now. So that's why the retail health loss ratios have started coming down. On GMC, the loss ratios have been constant, and they are better than what we used to see pre-pandemic, and that trend continues. The other piece is also on retail. On the group platform, we also write a lot of credit-linked products. There also the loss ratios have been very healthy and they continue. So to summarize, the only place where loss ratios seem to be higher are only because of the government health business in Gujarat, which we've written. And there also, just to give you a flavor, the way that normally these accounts work in the initial part when we take over the portfolio from another insurer, the first quarter normally has a lot of backlog getting reported. Now, some of them, because of the transition from one insurer to the other, is not actually due but reported, and hence you see in the first quarter the loss ratios normally shoot up, and then over a period of time they settle down, and that's what we are seeing now also. But the way we do the accounting, because these are reported losses but not settled, we will obviously account for it in the financial statements. So that's just to give you a flavor of the health loss ratios. Coming to the investment income, the big chunk of increase you're seeing is coming from the advance premium moving up. While obviously the investment performance has been good overall, that's because the yields have moved up in the last few quarters, I would rather say. And overall yields for the companies have moved up, and hence that benefit. But the larger chunk comes from the advance premium moving up. And like Srini summarized earlier, the advance premium for us has actually grown by almost 33% for H1, from about 1,250 crores last year, same period, to about 1,650 crores. So that's the big delta we're seeing now. Whether this sustains actually depends on how much of motor business we ride, especially the long-term one on two-wheeler and four-wheeler. So it will depend on that, and obviously the yields depending on the market. Now also, as we've discussed in the past, a big chunk of this growth in advance premium for us is coming because of the two-wheeler business handicap we used to run in the past. We don't call it a handicap anymore, because our market share, which 2 years back on two-wheeler fresh business used to be less than 4%, and now that's moved up significantly. And this quarter, in fact, that market share was upwards of 9%. So that handicap which was there earlier is now behind us. So barring one OEM, we've now tied up with almost all the OEMs, and that's why you see this significant growth coming in the long-term business, and because of that in the advance premium. So this is just to answer on the questions you raised on Bajaj.
Sir, actually, if you could address the reinsurance commission as a inward commission as a percentage of NWP, and just to clarify, what you are saying is that the impact on loss ratios from the government health will unwind later on.
I think what Raman indicated is that we have priced the government scheme based on our expectation of loss ratios, and this is also reinsured. I think almost 80% is reinsured, if I'm not mistaken, and therefore the expected loss ratios do consider, in a liability policy, usually there are claims made basis or claims incurred basis, but in a annually renewable policy like this is always claims made. That is, any claim reported after the new insurer takes over is treated as part of this 1 year tender. So this is, in a way, what Raman indicated is this is priced into the product. Now we'll have to wait and see over the next 2-3 quarters whether that falls in line with our expectation or not.
Got it, sir.
Also on the RI commission, you wanted to know the percentage, right?
Percentage of NWP, if you could give an indication, or the number.
I have the NWP handy, but the RI commission to RI ceded is about 14.5% for quarter 2.
Okay, got it, sir.
Thank you.
Good morning. So I'll take the 3 questions on the BALIC part. The first question was on the overall NBM growth on the H1 basis. So see, as we've been mentioning is that as of now we are investing into so many new businesses, whether it is signing up with the new partner, which Srini also covered that we have signed up with 6-7 more bank insurance partners. We are at the very early stage where we are as of now investing more than actually the throughput is there. Secondly, if you look at that, we have also started investing a lot more in the agency channel in terms of our new business lines or the channel within the channel. Again, they all are at a very early stage of the business expansion, and hence their NBV or NBM signature is lower. We always been saying is that for us what matters is the NBV growth, and if you look at our NBV growth has been 22% on a rolling 12-month basis also. So to that extent, I think it's a mixture of too many things moving. Within that, if you also look at that, our group protection is not grown, which typically is a higher margin business. That all is playing in, but our NBV strong growth of 22% is there. So that's the one on the NBV part. With respect to Axis Bank, our share in the business has come down from 25% to 23%. But in terms of the wallet share within the Axis franchise, we are there and thereabout at 28-29%, which is consistent to what it was last year. Axis Bank has been a good growth for us also, even in the H1 basis, the bank franchises for us has grown by 14%. Though our overall growth is 24%, so the share is coming down, but it is still a good share in terms of our business. That was your second question. Anything else was there on that? Anything else was there?
No, sir. On Bajaj Finserv Health.
Yeah. I think at Devang Modi here. So we work with all general insurance, standalone health insurance as well as life insurance insurers to roll out the healthcare benefit for their customers. We obviously are very proud to be servicing both our group companies on GI side as well as life side. In last quarter, we have added one Sahi player. It would be inappropriate for us to name the players, as well as one life insurer. And we are working with a lot of them to roll out our proposition to their customers. It's a long-drawn process. We create a proposition. They have to file the product. We have to integrate the systems. Then they have to take it to their distribution. So we are very happy with the progress. And in coming time, we are confident that we will be able to work with more and more players. I hope it answers the question you asked.
Yes, sir. Very helpful. Thank you so much and all the best to the team.
Thank you. Our next question is from the line of Bhavesh Kanani from ASK Investment Managers. Please go ahead.
Thank you for taking my question. My question was on Bajaj, where we have seen the expense ratio coming down, much lower than the historical trend we have seen. So if you can help us understand the reasons behind that.
So if you look at the expense ratio, if you see firstly the GWP growth which we've registered, that is extraordinarily high because of the government health business which we've written. And that's why you see the ratio factoring in this large bulky business which has got reported, it's looking like a very nominal number. So that's one reason why the expense ratio is looking abnormally low is what I would say. As we, as the business gets normalized over a period of time, you will see the ratio also normalize. And what we said in the past, the ratio is amongst the healthiest in the market, and we will continue to endeavor to do that. And that's how I will summarize it.
But it's also down on absolute basis year on year, and even the base quarter also had a fair bit of share, in fact a higher share of agri in the premium collected in Q2-23.
Yes. Overall also, if you see, you're right. If you look at the numbers on totality, expense plus acquisition cost, net acquisition cost is down by almost 7% on totality basis. But if I see it excluding the bulky businesses of crop and government health also, it's down by about 1.3% is what I recall. That's largely because of the growth we've registered, but we've not invested that much in business. And that's why, you're seeing the ratio improve. And what we've cautioned in the past as an organization, during the pandemic, we had actually scaled down a lot and we will be scaling up now. In fact, if you look at our employee count, pre-pandemic we had gone down, during the pandemic we had gone down to almost 7,700 people, and now we've already reached upwards of 10,000 people. So while the the expense ratio this quarter is looking a little lower because of the high growth, but just a word of caution is that for the next few quarters, because we are still investing in manpower, and we had also mentioned that we are getting into the rural parts of the country, so we are adding new branches there. So it may move up a little, but like I mentioned earlier, we will still continue to strive to be amongst the lowest in the industry.
So in effect, sir, we should not be taking this 95% combined as sustainable. What kind of number would you be targeting on full year basis, sir?
There, our endeavor is always to be better than the market. Now, the market, however, is unusually high. We know that the overall market is at 116%, but what we've been registering is close to 100%, and that's what we will endeavor for. And earlier, our journey used to be to aim at less than 100, but because of the investments we are doing now, which I mentioned a little earlier, we will probably be a little over 100% for the next few quarters is what I would guide.
But let me add to what Raman said. I think there are multiple forces here. One is obviously how the loss ratio moves. There are different segments, some of which have been favorable, some not so favorable, as highlighted earlier by Raman. And how they will pan out over the next 6 months is one factor. The second is the earned premium growth has been low. So when you look at expense ratio as a percentage of earned premium, there will be one factor which should result in a higher earnings on the existing business that we have written. And the third is the investments that we will continue to make. The advantage of the investments is if the growth comes next year also, we will get the benefit of operating leverage. And Bajaj, as overall on an expense ratio, they would like to be among the best in the market. So that journey will continue. And we hope over the next few quarters we'll be able to make it up. But as a combined ratio, we normally try to say that we would like to be below 100, because if you want to be at 90, you have to give up too much of business, and the incremental business you give to get the incremental profit is actually may lose market share or market position. So that is something that we balance. We have been doing that over the years, and we'll continue to do that.
Wonderful, sir. Thank you for answering my question.
Thank you. Our next question is from the line of Sanket Goda from Avendus Spark. Please go ahead.
Thank you. Thank you for the opportunity. Sir, this on group health, given you highlighted that 80% of the business is ceded. So considering the reinsurance commission, do you believe this business is less than 100 combined product ultimately means, or it will invariably be little higher than the company average? Just wanted to understand the logic of doing the business. Are you confident that with reinsurance it can be still delivered below 100 combined? That's one first question.
A broad answer which should answer the question, unless someone wants to add to it. In insurance, you always do business on expectation of profit. In the same way that customers expect that there will be a claim, and that is why they take insurance. The insurance company also has a certain probability of making money. If I definitely know that I'm going to lose money, I will never do that business. At least Bajaj would never do that. Therefore, in this business, our whole quotations are based on expectation of profit, based on the data that we have of the past year, the increase in the number of people, the type of illnesses covered, and various other things, the hospital rates that have been negotiated by the state government, and various other things. So our expectation is that it should be, on a total basis, it is priced to be favorable combined ratio. I think I will now give it to Tapan, because he is an expert in this subject and he can add a lot of flavor on how Bajaj approaches this.
Yeah, I think Srini, what you said is right. So I don't think anybody writes business thinking that this is how it is going to be. These are difficult, complex businesses, and we have expertise. We handle government health business, and that's why we write this business. And obviously, the outcome will depend on how the year goes by. If you have something like what happened in the previous outbreak of some kind of illness or disease, then the loss ratio moves up. If it normalizes, it comes down. So that's all calculated while we put up the term on that basis. So I think you really mentioned it well, Srini.
Got it, sir. The reason I was asking, sir, that in this government health, probably the float is not there because the government pays premium little later. Cash doesn't come in upfront. So it should be substantially below 95 combined to make a ROE which company reports. So just wondering whether the pricing is such a good.
In Gujarat, we have the condition the government is paying premium, no? So it is there. So and I mean that's why I say there are a lot of things that you add on to it, no, to look into how the business gets done.
Got it, sir. And on Bajaj, one last one on crop. Just wondering, given in first half we have grown, we have declined compared to first half of last year. Whether our ability to maintain the 2750 crores of business what we did last year in crop could be sustained in the current year, or you think there could be moderation and given the competition of UM, you believe crop might slow down for us going ahead?
See, you have to understand our philosophy first and foremost. We have never done business in a desperate manner. I think that is the first thing. We've always done business the way business should be done. You know, we have looked at opportunities where we can serve our customers well. We have tried to bring innovation. We have tried to bring efficiency, which was discussed in the just in the immediate past by the previous questions. We have tried to see how do we bring much more value to the customer than it can be thought of. So that's our philosophy. So it is never a philosophy to say that it is sustainable, not sustainable. And if you see our crop business also, I think if you look at the market rates and if you look at where we have written business, you will see that we have written businesses where we are able to serve well and deliver to our farmers and the country as such. So it depends on the tenders which come together. No, so these questions that if you say that we feel that will be undershot, overshot, I don't think is the way we look at any kind of business, be it government business, be it crop business, be it motor, be it health. It all depends on our pricing, our ability to find efficiencies and deliver to the customer of the highest order in terms of excellence. And that's why you see our grievance ratio has been among the lowest in the industry for like over a decade now. It's not even 1 or 2 quarters, every quarter for over a decade. If you look at our settlement ratios, those are obsessions. No? So I don't think that we measure ourselves in terms of, like, say, every quarter, every half year that should we be underweight. That's not a principle. We continue doing business the way business should be done. That is, to sum it up. So it just depends on how the future tender comes together.
Got it, sir. Sir, lastly, on Bajaj, one thing on two-wheelers. So our market share from 4 has gone to 9 on new vehicles. Maybe just wanted to understand there is more headroom for us to grow at a rate better than the industry, or at 9% incrementally we will be broadly growing at in line with the industry, because I can see from your quarterly numbers that compared to 23% kind of a growth, it has moderated to 16-17. Whether there is still room left over to grow at a rate better than the industry in two-wheelers.
Yeah. So as you have rightly seen, as companies and the market share gets bigger, the growth rate will only start moderating down. No, if you have 100% of the market, your growth will be what the market growth rate is. No, and fundamentally, if you understand from the perspective, so as somebody gains more market share, their growth rate gets moderated. But our ambition has always been that in businesses that we feel we have to have good presence, we have a reasonably good presence. So our strategy would remain to grow businesses where, as I told you in the past, where we feel that the pricing is right and we should be able to serve the customers well. We'd keep on pushing that.
Got it, sir. Sir, I have one question or two questions on Bajaj. So on Bajaj, just wanted to understand this non-par part or annuity part not growing meaningfully. Is it more to do with macro? That is the interest rates of the deposits are much higher and that's why we are struggling, or given the yield curve has become little flatter and IRRs you are repricing it and that product is becoming a unattractive product relatively. So just wanted to understand because that product seems to be under pressure for the industry as a whole. Just your understanding of how non-par or annuity business growth would be incrementally. That's on one thing. And second, naturally, you try to tell on that point on group protection. The reason for decline, is it we have withdrawn from some MFI portfolios because of the price competition or something else we need to read into it?
Sure. Thank you, Sanket. So on the first part is where your question is on the overall non-par saving as well as on the annuity, where the linkage to the overall say yield curve as well as the pressure in the industry, what you have seen it on the line of business. So there are 2-3 things which is playing in. So first of all, the overall returns, if you look at the customer IRRs, over the last 2 quarters has come down really what it was say in the quarter 4 of last year because of the overall change in the yield curve. Yeah. Within that there is a little bit of a technical aspect that's saying that the maybe the slope of the yield curve has much more flattened, which kinds of creates a pressure on the what can you buy it in the forward market. So that also reflects in the customer returns. So if the slope is little steep, you get a benefit. If the slope is flat, that also impacts the return which you can declare it to the customers. Despite that, overall interest rate has gone up. Yeah. That plays it in the pricing part. So I think that is true for most of the players, and so is it for us. And even if you look at in our case, last quarter we have reduced on the flagship product, our IRR has been reduced by around 18 to 20 basis points just to be aligned with the yield curve movement. Otherwise, see, there are only 2 aspects. Either you give it to the customer or you say that you will paying everything out of the margin. So it's a very chicken and egg story where you want to balance it out. But in general, whether it is annuity and non-par saving, I think the overall returns has come down from the customer, and coupled with that above 5 lakh rupees, there is no tax benefit. So that business which used to come in the guarantee side, which was more than 5 lakh, has actually reduced for us as well as what I've seen it for others also. We did update it to the stock exchanges after the union budget. The impact could be 3-4% of that business coming down. So one is that business has come down. Secondly, obviously the attractiveness of the IRR has come down, and 5 lakh and above size has come down. So those are playing it. But broadly, I don't think so that the choices of the customer has said that the guarantees business is not in the flavor. If you look at even in absolute basis, our business would be there and thereabout. But because the company has grown faster, the share is coming down. But it at times works is like in quarter 1 for us, we launched a ULIP and it took a flavor. In quarter 2, we launched a par product, it took a flavor. So at times those flavors also plays in, but otherwise there is no change per se, I would say, from a customer perception on the guaranteed business. So that should come back or would streamline in the coming quarters. So that's not the concern. The second question, Sanket, was?
On group protection, basically, why slow down? Is it MFI withdrawal, price competition? Just wanted to understand reasons around it.
So like in our case, there are 4-5 lines when we talk about group protection. One is the MFI business, and within the MFI business, we have seen a degrown. This is again a temporary in our case because one of our partner is undergoing a process change. So to that extent, it is already closed by end of Q2. So this will start reflecting from Q3. That's one. The second is if you look at our group credit protection, that has actually grown marginally. Again, that is more linked to the overall credit offtake by the distributors because it's more like an attachment product. So if anything slowness happen on the credit offtake, it reflects on the credit protection. The third is the group term life, which is an employer-employee. What has happened over the period, after the COVID, the prices has actually come down. Almost the price correction is before pre-COVID level, which is down by 30 to 40%. All I can tell you, like in Q2, we would have added around 72 new GTL policies versus what it was there in the Q2 of previous year, around 40-42. But one, the size is lower, and second, the same renewal has come out at a very comparatively a lower prices because of the price correction. So that is reflecting in. In our case, one thing has also changed. PMJJBY, we started doing it from last year. Last year it came in Q2, but this time it came in Q1 because the policy is typically from April to March. But because we picked up some policies last year in Q2, so it reflected. So it's like a timing difference. Having said that, those are the 3-4 variables. I don't see any significant change. Yeah, it could be a quarter-to-quarter movement which is playing in. Otherwise, there is nothing drastic change other than in one of our MFI partner businesses slowed down. But otherwise, even MFI business for us has gone up significantly during the quarter 2, excluding that one-off adjustment which will be corrected in October starting this month.
Got it, sir. Perfect. That's it from my side. Thank you very much.
Thank you. Our next question is from the line of Supratim Datta from Ambit. Please go ahead.
Thanks for the opportunity. So starting off with...
Sorry to interrupt. Mr. Datta, may we request you to use your handset, sir? You're not audible.
No.
Hello?
Can you hear me now?
Yes, sir. Please go ahead.
Yeah. So starting off with the Bajaj business, now on the motor OD side, the loss ratio has improved to around 63%, despite the flood losses in northern India. So just wanted to understand, one of your peers has also reported significant improvement on the motor OD side. So just wanted to understand at the industry level what is happening, why has the loss ratios improved significantly? Are you seeing any change when it comes to competition, or what are the other factors which would have resulted in this? That's the first question. Now, coming to my second question on Bajaj. So you have taken the group health business, government group health business. Just wanted to understand is if the Gujarat business hits your benchmark, then would you next year go ahead and bid for more government health projects? Would that be the strategy? So those are the two questions on Bajaj before I get into Bajaj. Thank you.
On the motor OD, I'll give it to Raman and Tapan later to expand. But largely, I think Bajaj usually is very good at selecting businesses. So when we see loss ratios and we go to counters or we grow segments of business, whether it is private cars, two-wheelers or commercial vehicles, Bajaj always is very, very disciplined in the way it looks at data and decides to slow down business where loss ratios are high and where the losses are expected to be lower. So that's a disciplined process. Across the market, we cannot say because there are smaller companies which will take a business that we won't write. So that we'll have to wait for all companies to come out with a disclosure and see where it stands. But largely, I think that is what it is.
I'll just add to what Srini said. See, one outlier actually in the current year vis-a-vis last year was that last year, if you recall, Q1 was the first full year after the pandemic, and there was this concept of revenge travel, and because of which the OD loss ratio has actually gone off the roof. At least in my tenure in the GI company, I had never seen OD loss ratios go so awry, and that's why there is this base effect sitting there. But if you look at the OD loss ratios now, and if you compare it, a few years earlier, I think they're at similar levels. So they not that it's significantly come down from those levels. It's only a impact from last year because last year was largely overstated because of the revenge travel. And on the government scheme, see, as has been the case, and what Tapan always tells the analysts is that we want to be in every line of business. Given the fact that we are a GI company, whatever is the opportunity, we try to capitalize on that as far as it makes commercial sense for us. And the same way, where people used to challenge us when we started doing the crop business. And I think that's one segment where we've proven everybody wrong and tried to make money where everybody else was losing money. So I think the same fundamentals apply here also. As far as it will make commercial sense for us, we will continue to, stretch further and get into other states also, is where we will park it.
Got it. And one final question on the Bajaj business. So, the 5-year policy which, came into being, that is running off, that has started running off. So the first policy is there, 5-year tenure has come to an end. So could you let us know that, what kind of renewals you are seeing in those policies and, how much of your earned premiums typically would be from these policies?
So I don't have the data handy. Maybe we could take it offline and I'll share some details.
All I can say is, the reason the Supreme Court ordered 5-year policies was because there was a very large number of two-wheelers which did not have insurance after the first year. Mm-hmm. Now, with this coming in, overall, we have seen an increase in the renewal ratios because these policies do have cover. And within Bajaj, I think we have focused quite a lot on renewing, and our renewal loss ratios for two-wheelers have gone up substantially. It used to be in the order of 25-30% a few years ago. Now we are closer to 40-45%. Having said that, whether after 5 years these people will continue the insurance or not, one has to wait and see. But it is too early to say how much it is. We don't have the data handy now.
Got it. That's very helpful, sir. And lastly on
Offline, and we'll share the details.
Sure. On BALIC, just wanted to understand, some of the distributors as well as, peers have indicated that distribution costs have increased following the change in the UM guidelines. So just wanted to understand what you are seeing and, which channels are seeing a higher demand for, payouts. If you could give some color on that would be very helpful. Thank you.
As you know that we have many distributors, including banks, brokers and all. We haven't seen any increase in the cost just because EOM has been made flexible. So I personally haven't seen, and neither BALIC has seen that cost pressure because of the EOM being flexible. It is just that the flexibility helps you to look at commission rewards more directly rather than ground level activities. But otherwise, there is no increase per se in the cost of acquisition.
And just a follow-up on this, so as an industry, are the life insurance players, are you communicating with other players and, trying to come up with a more rational, cost, distribution payout structure? Because, just to understand, how competition would play out going forward.
I think this is you're referring to a newspaper article where there was a discussion going on the group credit protection to have a one